Well, good morning again. Jim Hagerty with Bartlett Wealth Management, joined by my colleagues Chris Robbins and Matt Stith. We still have some people trickling in. We had well over 100 registrants, but we'll get started now. And by way of introduction, at the bottom of your screen, you'll see a Q&A function, and that is there so that in the course of our discussion, as questions occur to you, we want you to submit them. Many of our registrants submitted questions in advance, but by all means, as they occur to you during our discussion, submit them. And we expect that about half of our time together today will be dealing with your questions. So we really welcome them. We had a strategy update webinar in January that was well attended. And of course, in January, we were coming off a banner year in the markets. Stocks did very well in 2021 and bonds had positive returns. And we kicked off our webinar then by talking a lot about risk and how we think about risk and how we seek to control it. We felt it was timely to talk about that given that markets had been so strong. And I wish we weren't so prescient, because here we are 6 months later in July and we're in the midst of a bear market. And the bear, rather angry bear, has left her tracks in both the stock and bond market, as we'll show on this next page. And there it is, a lot of red numbers. We show 4 stock indexes here: the S&P 500, the Russell 2000, 2 foreign stock indexes called the MSCI EFA and the MSCI Emerging Markets. And then we show 2 bond indexes, 2 Bloomberg indexes that cover the bond market. I'm going to touch on just 2 of these indexes. The S&P 500, pretty well-known index of large, primarily blue chip companies. Apple is the largest company in the S&P 500. Procter & Gamble, based in Cincinnati, is the largest consumer products company in the index, and Abbott Labs, for our Chicago friends, is one of the largest healthcare companies in the index. But that index of 500 very strong companies down 20% for the year. And then in the lower right of your screen, you see the Bloomberg US Aggregate Index. That is an index of bonds, sort of an all-encompassing index of bonds, various types of government bonds, corporate bonds, and that's not a misprint, down 10.3%. So bond prices down in the first half of the year. It's very unusual. Historically, when we've had significant sell-offs in the stock market, bonds have acted as a shock absorber for balanced investors, and bonds in those difficult periods of time, stressful periods, have usually had positive returns. But here we are for the first half of the year with a synchronized decline, stocks and bonds down in tandem. And an amazing fact for you, our research shows that that kind of synchronized decline in both categories has happened only 3% of the time since 1926. So pretty difficult bear market. And how do we get through them? Well, as we'll show on the next page, and to preface this, I'll say Bartlett has navigated many bear markets over the years. And on a personal note, this is my 8th bear market since I started my career 32 years ago. So the cadence seems to be, roughly once every 4 years. And how do we get through a bear market with our psyches intact, with our portfolios still appropriately invested and positioned for the long-term rewards the market provides? Well, we think there are just some key operating principles, and we summarize some of our favorites here. First of all, we never forget that investing is a marathon, not a sprint. And I can assure you that this time last year, there were no somersaults and victory laps at Bartlett when markets were strong. And similarly today, there isn't any mourning going on downtown. We're just as pragmatic and objective as we always endeavor to be. It is a very rewarding marathon. If I look back just on my time, 32 years, The S&P 500 index that I showed you earlier has compounded at about 10% per year. And that just makes for marvelous wealth creation over a long period of time, notwithstanding the occasional bear markets along the way. So if you were a resilient runner and you stayed in the race, the marathon is very rewarding. A second point we always make is that your portfolio will be disrupted from time to time. Almost every year, as we showed you in January, the market has at least a 10% setback. So your portfolio will be disrupted from time to time, but a careful financial plan should not be disrupted. And a careful financial plan that features appropriate guidelines for controlling risk through asset allocation and withdrawal planning and other kinds of initiatives, that should make for a steady lifestyle. We don't think any Bartlett clients need to switch from enjoying steak in 2021 to spam in 2022 or some other version of austerity. A financial plan should not be disrupted. We think back on 8 bear markets for me since 1990, or countless more for the firm in its history, and you ask yourself who really loses in a bear market. And the answer in this third point is that the investor who sells, and that sounds simple, but it's true. The investor who's resilient, who has a good financial plan that gives her the fortitude to stay with her investments, and just as importantly, to look for opportunities created by distress in the markets, that investor should be just fine, even though bear markets at the time are anything but enjoyable. But the investor who sells is the one who really locks in a lasting penalty. And finally, we just try to practice risk management at all times, always thinking about asset allocation and appropriate safeguards and accounts. If you wait to do that until markets are in disarray like they are now, you've waited too late as an advisor and disserved your clients. So these are certainly some key principles that have helped us navigate past challenges, and we're pretty confident they'll help us get through this current challenge with the long-term potential of portfolios intact. So now I want to turn to Chris Robbins, the first of our experts. Chris is in his 11th year with Bartlett. He's a chartered financial analyst, pretty smart guy in my opinion. And Chris focuses on fixed income portfolio management for the firm. So he's one of our bond experts. And he's an ideal person to kick off, and update us on this inflation situation that has been so difficult for the markets this year. And so Chris, let's hand things off to you with an opening question. We got another pretty sobering update on inflation this morning. Is there anything in all the indicators you're tracking that gives you or allows you to share with our listeners and viewers any hope that this fever may be peaking sometime soon? So take it away.
Sure. Thanks very much, Jim. Yeah, so inflation is one of the top concerns on investors' minds right now. And one of the reasons for this is that for a very long time, there was very little inflation in the US. For the 20-year period leading up to 2021, the consumer price index in the US increased by an average of 2.07%. As of yesterday, CPI was most recently measured at 8.6%, and then we received a new reading this morning, which isn't shown on this page, but it increased further to 9.1%. So obviously, looking at the chart in front of you, you can tell that from March of 21 to now, there's been a very significant increase in inflation. So 9.1%, that's a big decline in purchasing power in a short period of time. The implications for this is obviously consumers are paying higher prices. Input costs for businesses have risen, which can squeeze profit margins. It also means that bond yields have increased to compensate investors for these higher inflation numbers. So inflation at these current levels has proven to be a headwind for both stocks and bonds. But to answer your question, do we see any hopeful signs? The answer is yes, we do. So first, the Federal Reserve, which sets monetary policy in the US, has taken an aggressive stance to cooling inflation. Following their most recent meeting on June 15th, the Fed raised short-term interest rates by 0.75%, which was considered to be an aggressive move. The Fed meets again later this month, and it's expected they'll raise short-term rates by another 0.75%. So that's a positive sign, but that doesn't change the fact that inflation is still 9.1% right now. So where do we see inflation going in the future? That's another question that's on investors' minds. And what's in front of you here is what the market thinks inflation will be in the future for 2 time periods. The orange line is the end of March, and the blue line is the end of June. And I'll describe kind of what's going on the chart here a little bit more. On the left side, you have the rate of inflation. And on the bottom, you have the number of years in the future, from 1 year all the way out to 30 years. And so at the end of March, investors thought that 1 year from now, inflation would decline to 5.84%. 2 years out, the expected rate was 4.56%. And then at the 10-year mark, investors thought that inflation would be 2.83%, looking out 10 years. So again, just looking at that orange line, which was expectations at the end of March. Now, moving to the blue line, that's the end of June. That was after the Fed made their recent rate hike decision. And you can see that inflation expectations are lower following that event. So at the end of June, investors thought that 1 year out, inflation would be about 4.25%. 5 years out, inflation would get down to 2.75%, and then 10 years out, it would get comfortably below 2.5%. So again, this isn't us making a prediction. This is essentially just us listening to what the market thinks inflation will be based on how bets are priced. And what the market is telling us is that investors expect inflation to come down pretty meaningfully from current levels. That was the case at the end of March, and the expected decrease in inflation is even more pronounced now following the recent Fed decision.
Chris, what kind of bonds make sense in this environment? What are the best opportunities you're seeing in fixed income?
We think that high quality corporate bonds with maturities less than 5 years are very attractive right now. A 5-year A-rated bond, for comparison, yields a little bit less than 4%, pretty close to 4%. That's almost a full percent more than the yield that's available on a 5-year Treasury bond. It's also worth mentioning that for conservative investors, short-term Treasury bonds are more attractive now than they have been in a long time. So a 2-year Treasury bond yields 3%. You receive the same 3% for buying a 10-year Treasury bond. So it's possible to enjoy the same amount of yield in the 2-year without taking on a higher interest rate sensitivity of longer maturities. A diversified bond portfolio will definitely have bonds with a range of maturities from short to long in most cases, but we can be opportunistic based on market conditions. And right now, short-term Treasuries are more attractive than they have been in a long time.
So Chris, as we showed earlier, decline in the bond market, big shakeout. So you're seeing some opportunities, but tell our viewers, what might be a few areas that still look perhaps scary to you, areas that you would avoid?
We would be careful with bonds with really very long maturities that carry with them more interest rate sensitivity. So, 30-year corporate bonds, for example. Sometimes there's a place for those in portfolios, but we wouldn't get over our skis investing in that area of the market, just for the fact that we take we're taking kind of a conservative stance with interest rate sensitivity in that segment. Another area is preferred stocks. So we own some preferred stocks in fixed income portfolios. But in years past, we've had a much higher weighting than we currently do. And that's for the same reason. Preferred stocks can have higher yields, very attractive yields compared to corporate bonds in a lot of cases. But with that, they also carry with them some higher interest rate sensitivity. And so there are a few that we've used and own in portfolios, but again, we're not taking a very significant overweight to that area of the market, just to be a little conservative.
So you're finding more opportunities, but still biased a little more to safety.
Yes, that's very accurate.
Great. Well, we'll let Chris catch his breath. Matt Stith is in his 16th year with the firm, and where Chris focuses on fixed income, Matt is one of our stock experts, our leading stock expert. He is a portfolio manager and director of our equity research process. And if you were with us in January, why, you remember Matt was one of the stars of that performance. And Matt, you talked a lot about risk in January. You didn't make any promises that we could eliminate it, but you talked about how we try to control it in accounts and in our equity selection process. And update us on your thinking now and how you're thinking about things, and how the stocks that you're focusing on are poised perhaps to withstand these inflation pressures that seem to be entrenched.
Great. Well, thanks everybody for joining us. Yeah, so as Jim highlighted, it's been a challenging year in the markets thus far. Specific to stocks, we've seen a sharp correction in high growth, high valuation names, including some of the pandemic favorites. Think about names like Zoom and Peloton and DocuSign and more recently Netflix. This group's been particularly hard hit. And when you think about it, the math behind it makes sense, and it's really pretty straightforward. Today's stock price should equal, future projected cash flows discounted back at some interest rate. So as that interest rate increases, the present value of those the present value of those future cash flows is going to be less and less. So this first chart shows the S&P 500 as represented by the blue line. It shows the price to earnings multiple as represented by the red line, and then current corporate earnings projections, which are represented by the gray line. So the PE multiple is a valuation metric, essentially what an investor is willing to pay for a future stream of earnings. What this chart is telling us and what it's showing us is that the market's decline has really been all a function of the compression in that PE multiple. So you can see the market and the PE multiple have followed really that same downward trajectory. Interestingly, and maybe even somewhat concerning, is that corporate earnings projections have remained flat throughout the year, and they've actually increased a little bit. So despite higher interest rates, higher inflation levels, and even some predictions that the economy may fall into a recession, analysts, economists, and even corporate management teams have not lowered earnings expectations just yet. This is potentially a risk and something that we are monitoring. The second chart I want to show you is a historical look at the PE multiple. So as you can see, the PE multiple has compressed to a point where it is now back in line with long-term averages. This suggests to us that equities are certainly more reasonably valued than they have been in the last several years. But again, this also assumes that we're not going to see a change in corporate earnings projections. For those of you that were with us back in January, we talked about our goal to deliver clients a portfolio of stocks that will generate positive risk-adjusted returns through an investment cycle. I use the term all-weather portfolios, meaning a portfolio of stocks that will do well in up markets and will do better than market averages in periods of decline. We continue to work to deliver this strategy, regardless of economic and market conditions. Really, at the core of this is our disciplined and diligent research process. And this is something, again, that we spoke about in January. Central to the process is identifying investment opportunities that possess, desired company and stock characteristics. So as a reminder, the company characteristics that we look for largely center on quality, and they include things like market leadership positions, competitive advantages, strong financial characteristics, solid growth opportunities. We like companies that have a favorable shareholder orientation, and certainly companies that provide differentiated technology and essential services. As it relates to the stock, valuation and risk top our list. One trend that we are seeing in the market year to date is investors gravitating towards high quality dividend paying stocks as a way to reduce risk, as well as a way to hedge against inflation. So again, circling back to January, we highlighted equities as a prospective way to hedge against inflation. As a reminder, corporate earnings tend to increase during inflationary environments, and this can allow management teams to raise dividends. In addition to the many robust dividend increases that we have seen, year to date, companies remain very active in repurchasing shares. This should help support earnings per share growth as well as stock prices going forward. And, we think highly of management teams and insiders that opportunistically buy back their shares when they feel they're undervalued. Again, as I mentioned in January, and something Jim alluded to, understanding risk, where our risks are in portfolios, and how to control that risk are key pieces to how we construct and manage portfolios. And again, this starts with buying companies that we feel are high quality and where we feel the valuation is reasonable. Additionally, we can adjust things like sector exposure or our weightings as a way to shift portfolio risk. So, sometimes in the market, we may look to decrease overall portfolio risk, and we do that by maybe increasing our exposure to some of the lower risk sectors in the market. We also control risk by blending both value-oriented stocks with reasonably priced growth stocks. And to keep a tab on our risk levels, we look at a number of risk-based statistics, things like standard deviation and beta and the Sharpe ratio. Additionally, we stress test our portfolios through simulation models for things such as large market corrections like what we're seeing today, higher interest rate environments, and of course, rising inflation as well. One other aspect of our investment philosophy that I want to touch on is our long-term perspective. This is truly one of the pillars to our investment approach. We don't buy stocks with the expectation that we're going to make a quick profit, sell, and move on to something else. And as Jim mentioned, our investment thought is more along the lines of a marathon, and not a sprint. We view ourselves as owners of a business with the intention to be shareholders for many years, and we will remain patient to let our investment thesis play out. Taking a long-term perspective allows us to be opportunistic in both stocks we own as well as new ideas. Often adding to our existing companies or companies that we currently own in portfolios, it proves to be the best investment decision. We will buy stocks in share prices that are declining, so long as our investment thesis remains intact and our conviction level high. And, again, sometimes these prove to be the best ideas, especially if this is a name or stock that we maybe have owned for many years and we understand in great detail. Additionally, market corrections like what we are seeing today may provide opportunities to buy other high quality companies, especially ones that, for valuation reasons have maybe been outside of our reach for many years. The key is taking a long-term investment perspective and being patient for some of these opportunities to arise.
Matt, what are some examples currently where you found opportunities, maybe you mentioned on the growth side of the spectrum as well as the value side of the spectrum?
Yeah, definitely a timely question, Jim. So we are seeing opportunities both in our current portfolio of holdings as well as potential new ideas. Again, getting back to what I just said, some of these new ideas are names that had largely been priced out of our reach over the last couple of years, and given our value orientation, things that we we historically don't want to chase, but have come back to us as far as that price level goes. But one example, we recently took a new position in a high quality market leading technology company called Intuit. Intuit, like many other highly valued technology companies, has sold off pretty significantly from its highs back last year. In the case of Intuit, it's down about 40% or so. At the same time, we've also added to one of our favorite financial stocks, JP Morgan. This is a company that fits more on that value spectrum, trades at a P multiple of around 10 times and offers a very attractive 3.5% dividend yield. So, so I guess the answer to the question, Jim, is we're finding opportunities, on all sides of the spectrum, whether they're growth names that are more reasonably priced today, whether they're value names, new ideas, or even, repositioning into some of the existing companies that we already own whose share price maybe have been hit a little bit harder in the market this year. So I guess the point is, we're going to continue to use the market volatility to identify new ideas, as well as build position in existing holdings, and really trying to pivot client portfolios to the best long-term opportunities where our conviction level is the highest.
Well, Matt, let me ask you the same question I posed to Chris. We've had this pervasive market decline. You're seeing opportunities, here, there, and everywhere. But what areas of the stock market still scare you, for lack of a better term? What areas do you think are still vulnerable and you would avoid?
Yeah, so as I think about that, Jim, obviously we've had big corrections in a number of names and in sectors within the market, but there are still some areas that, I think I would be cautious with. I did call out, high valuation, growthier technology stocks. And although we've seen a big correction in this group, I'm still a little bit cautious. There may still be some speculation, especially for some of the let's just say less mature companies. I feel good about, kind of the more mature blue chip companies, but I think, some of the smaller ones, there still may be a little bit of speculation in them. So I'm careful there. Those names tend not to be on our radar screen and in client portfolios. Two other areas that I might cite, energy. We've had this significant run up in oil prices, and the energy stocks have followed suit. I'm a little cautious there. You think about two things. One, if our economy does fall into a recession, historically that has pressured oil prices. Secondly, depending on what can happen in global markets, again, if global economies start to slow, that's going to increase the supply of oil as demand will begin to shrink. Both of those two factors, I think, could really pressure the price of oil. And, if oil prices begin to fall, so too will energy prices. And then maybe the third area that I would call out, and this kind of gets back to, some of Chris's comments, some of the consumer discretionary stocks. Consumer has been spending and spending at heavy levels for quite a while now and continues to do so right now. But, again, with gas prices where they are, with core inflation running at 9%, with costs in the grocery store continuing to increase and whatnot, you just wonder if sometime the consumer is going to look at reducing spending elsewhere. So maybe some more of the discretionary spending areas might come under a bit of pressure, and obviously the companies in stocks that participate in that space. So those are three areas which I kind of call out to where I remain cautious at this point.
Thanks, Matt. Well, we have about almost half of our hour allotted left for questions, and we had some submitted beforehand. We've had some submitted while we've been talking, and I encourage our participants use that Q&A function to submit more questions as they occur to you. We had some excellent questions come in, and Chris, I think the first one is right up your alley. In light of this latest inflation news just out this morning, the questioner wonders, will the Fed have the fortitude to keep tightening, keep raising interest rates if we slip into a recession? Or, will they blink, lose their resolve? And secondly, somewhat related to that, the question would be maybe looking ahead to that kind of environment. you talked a lot about preferring safer, shorter maturities now. This same questioner wonders, at what point do you begin thinking about adding duration and buying some longer bonds and preferred stocks that presumably would do better if there's an economic slowdown? So two-part question about the Fed's resolve and duration, and you take it away.
Okay, great. Thanks, Jim. So will the Fed blink? Basically, will the Fed stop hiking? I don't think so. I don't think so. If you look back historically, throughout any hiking campaign of the past 50 years or so, the Fed has never stopped hiking before the Fed funds rate was above CPI. And so for the Fed to stop hiking prior to reaching that would be a departure from how they've operated in the past. So historically, it seems like the Fed is most concerned about getting inflation under control, and avoiding a recession is secondary during hiking cycles. So that's the answer to the first one. The Fed probably won't blink. They'll probably keep hiking until inflation is under control. And then to your second question, does it make sense to add duration? Duration is a measure of interest rate sensitivity in bond portfolios. So longer bond maturities carry with them more duration and more interest rate sensitivity. We've taken a pretty conservative approach over the years with regards to duration. At times, we've been slightly less than our benchmarks, taking on slightly less interest rate sensitivity. But right now, we're actually pretty close to our benchmarks in a lot of cases, and so I don't think we would consider trying to take on more interest rate sensitivity than the benchmarks we're using to manage our bond strategies. But making sure that we're close to our benchmarks within the guardrails we've set for ourselves is always a wise thing to do. So no need to make any dramatic changes with regard to interest rate sensitivity for bond investors.
I was muted there. Chris, another questioner concerned about inflation. Many of our questioners are. And you touched on this somewhat, but she asks for any guidance as to how long these pressures may last, maybe when the fever may break and inflation begin coming down. I guess those charts you shared earlier suggest that relationships in the bond market are suggesting, some relief later this year and into next year, but could you expand on that?
Sure, absolutely. Definitely within the next year, if you believe the market is correct in how they're pricing in inflation expectations, you would expect inflation to peak sometime in the next 12 months. As to whether that's 3 months from now or 6 months from now, that's difficult to tell from that data that we showed earlier. But assuming the market is correct, you would expect inflation to peak sometime in the next 12 months.
So Chris, that begs a follow-up question. What you're saying is, rather than make a specific, unique Bartlett forecast, you and your team feel it's much more reliable to look at these relationships in the U.S. Treasury bond market between inflation-protected bonds and regular bonds, and that has had pretty good predictive power historically in terms of signaling where things are going, better than just an individual economist's prediction.
Absolutely. There's thousands of investors who are making bets on where they think inflation will be, and the aggregate of those bets shows us what the market thinks, and we don't try to outsmart the market. If the market is telling us something, then it's good to listen. It would be a good way of putting it.
Great.
For us to say that inflation is going to do something drastically different from what the market thinks would be, it would be equivalent to thinking that we're smarter than the market, and that's not a position that I think we necessarily want to take.
Well, Chris, I was going to let you catch your breath, but while you were talking, a great question came in, a timely question. Are TIP, Treasury Inflation Protected Bonds, a good investment now? I know you've emphasized those at times. What would be your current thinking about Treasury Inflation Protected Bonds or TIPS?
Yep. So we own TIPS in client portfolios of varying maturities. It's definitely what would be considered an out of benchmark bet. So the benchmarks that we're comparing our performance to don't have TIPS in them. So for us to buy TIPS, that's definitely us saying that we believe they'll outperform nominal treasuries. So we do have some exposure. It's not a huge portion of bond portfolios, but owning TIPS will benefit investors if inflation stays higher for longer, or if the actual inflation numbers end up being higher than those expectations that we showed earlier. So having some TIPS in portfolios is definitely something we're comfortable doing. I don't know that we're considering adding more TIPS at this point for bond investors, but we're comfortable having a small position as a bet that inflation could be higher for longer.
Great. Chris, well, you better catch your breath. A few more questions for you, but let's turn to Matt for one of the questions. And any perspective, Matt, on how long bear markets typically last? And 6 months so far.
It's so that's a tough one to answer, Jim, because it's really all across the board, and it's something I've seen more and more information on over the last couple of weeks. But you think about from how short a bear market can last, it could be as short as a month. You think back to the early days of the pandemic and 2 years ago, and that bear market was about a month, 30 some days, I think, all told. You look at one of the longer bear markets, you think about back towards the financial crisis, that was kind of about 17 months. Go back to the dot-com bubble, kind of the early 2000s. I think that bear market was about 2.5 years. So it can really be all across the board. I think the average, again, depending on what time period you're looking at, but say over the last 60, 65 years, I believe that average bear market is somewhere right around 13 months. So just over a year.
Matt, a questioner asks, looking at the various market indexes we showed, and the S&P down 20% by way of example, what would you expect would be the decline in a typical Bartlett stock portfolio, given how you've talked about risk and how we think about it?
Sure. Yeah. So without kind of getting into specific numbers, I mean, I would say as we've talked about, kind of how we manage portfolios, how we monitor and measure risk. Our goal is to do, obviously better on a relative basis to the S&P 500, and maybe two components of that. You think about, most of our Bartlett clients are going to have balanced portfolios. So it's going to be a portion equity, it's going to be a portion fixed income, maybe some cash. So just by nature of the diversity, if you wanted to compare a balanced portfolio to, say, the S&P 500, Bartlett client portfolios should be doing better. And then specifically, if we're looking at that equity bucket, given our lower risk profile, given the kind of companies we focus on and the kind of companies that we stay away from, yes, we should be doing better to a degree. It's hard to say what that degree is. it's not going to be, half, but it's going to be, a certain percentage better. And, I feel like we're achieving, some of our goals this year as it pertains to what we want to deliver for clients.
Certainly, Matt, the model portfolios that you focus on and that we use as guideposts for our accounts have held up better so far. So hopefully that continues.
Yes. Yeah, that's a safe statement. Definitely.
Number of other questions on inflation, and they're very good ones. What is the cause of recent inflation? Why so much so soon? And what's the trajectory of it going forward? I get this question an awful lot, and I've shared with clients that I think what we've experienced over the last year is almost analogous to a post-war experience. Maybe the last time we had that experience was coming out of World War II, where you had tremendous pent-up demand that collided with inadequate supply as business needed to reindustrialize. And for a couple of years after World War II, we had a real inflation problem before it settled down. So I do think there is something to this argument of these bottlenecks, these supply chain issues, these unique things coming out of the pandemic. But questioner asked how much of this is tied to the Ukraine war. Chris, I guess we could say, going back to your chart on inflation over the last year, this was manifesting, well before Ukraine perked up in February. And I wonder what your perspective would be, Chris. Hindsight is always 20/20, but it sure seems like the Fed should have been applying the medicine they're applying today, maybe 6 months ago. Obviously some hindsight there, but what do you think?
Yeah, maybe so. It's really easy to criticize the Fed. It's kind of a hard job, but the important thing is that it seems like right now they're very serious about getting inflation under control. So maybe it would have been best to start that process sooner. Maybe it would have been less disruptive to markets, but it's difficult to tell. Yeah.
Matt, the benchmarks we showed earlier, it kind of showed that the world markets, the developed markets, the emerging markets kind of rhyme with the US, declining by close to 20%. Any thoughts on that? One of our questioners asks, have those foreign markets declined by more or less, and why?
Yeah, I think you hit it on the nail on the head, Jim. It's kind of similar type performance. A lot of those foreign markets have not been as strong as ours the prior several years, making kind of that sell off even a little bit more painful. But yeah, especially when you think about some emerging markets and some of the headwinds that they may be facing that we may not necessarily face here in the U.S. And one that really stands out is commodity costs. A lot of the emerging markets are kind of plays on commodities, and many commodities are priced in US dollars. So when things like oil becomes much more expensive, some of the agricultural products become much more expensive, that really impacts some of these emerging economies that not only import a lot of those, but even trying to sell those goods in US dollars becomes a bit less profitable. So from a risk perspective, from thinking about safety, thinking about investing in higher quality areas, I think we're a little bit more favorable probably on domestic large caps versus the emerging markets in this kind of environment. There's probably going to be a time where emerging markets begin to look a little bit more attractive to us, but I think just again, given so much uncertainty in the market, fluctuating commodity prices, I think we like the safety and security of our domestic holdings today.
We've had a couple of questions looking beyond equity and fixed income, the realm that broadly called alternatives. And Chris, one questioner wonders current thinking on gold. How has it fared during this storm, and should it be an investment that would be considered now? So your thoughts on gold?
Sure. So gold year to date is down just under 4%. which is less than a lot of the equity indices that we showed earlier, but still down. So this year, there's been very few safe havens aside from cash. Whether or not gold is a good investment, at Bartlett, we don't include gold in portfolios. A couple reasons for that. Our expertise is really on valuing assets on the investment side, and doing things like looking at cash flows is an important part of our process. So for an asset like gold that doesn't have cash flows associated with it, it's a little too unusual for us to apply our traditional valuation process. So that's our stance on gold right now. It is something that we discuss occasionally as a team and say, well, maybe we should look closer into this or evaluate it. And so it is something that is on our radar, but at this time we're not using gold in client portfolios.
Thanks, Chris. I know when I'm questioned about it occasionally, you can't, as you say, you can't value it the way you can a stock where you've got dividends or earnings, or a bond where you've got interest. It almost seems like it's an investment more based on nostalgia for the gold standard or something like that. Related question, Matt, maybe you would take up. You focus on the public equity markets, stocks, but any thoughts on private equity as an investment now?
Mm-hmm. From our perspective, or my perspective, I think there could be some opportunities in private equity. And you think about the last couple of years, younger companies, less mature companies had no problem accessing, whether it be public markets, whether it be capital from banks or other funding sources. That's really changed within the last year. One, much higher interest rates, so borrowing costs are going up. We're not seeing as many IPOs right now. The year started off pretty strongly. That's begun. That has slowed down quite a bit, as weak equity markets are not the best time to do a public offering. So where are these younger companies going to go? And that's probably going to open up the doors for some private equity opportunities. So yeah, I think that has become or will become more of an interesting asset class going forward. And maybe allow some people that haven't been able to participate, outside large pension funds or whatnot. Maybe they have an opportunity to start to get involved in some private equity here, while public markets remain a little bit more challenging.
Great. Well, we had some excellent questions today, and just really superb participation by our viewers and listeners, and we very much appreciate that. It's not fun to go through these bear markets, but as I said, it's the 8th one for me, and goodness knows Bartlett as a firm has been through multiples of that. And we feel so strongly that it's not so much the bear markets, but how you behave, as it were, in bear markets that is really important. And everything we're trying to do here as a firm is all about instilling the confidence and the fortitude of an investor to stay with a long-term plan, and that allows you to capture the benefits, the real marvelous bounties that markets provide. And everything we're doing, whether Chris and his team in fixed income, Matt and his team working as hard as they can on stocks, is really geared toward that, to really maximizing the chances that a client experiences the rewards of the market long-term, and doesn't lose out for either behavioral or financial reasons when these bad times happen, as they do to varying degrees. So it's a bear market. I think we've been very candid about it, how we're trying to get through it. And with that, we're just about at the hour. So I'll just say thank you to everyone who joined us today. And we wish you a very happy and fulfilling summer. And we will probably be back for another webinar after the 3rd quarter. So thank you very much, and good afternoon.